In 2022, the safest, most universally recommended investment strategy on Earth well, it suffered its worst year since the Great Depression.
Yeah, it was brutal.
Right. I mean, the 60/40 portfolio, absolute bedrock of global wealth management. It's basically the default setting for almost every retirement account in existence.
And it didn't just underperform, it structurally broke.
Exactly. The bonds that were supposed to, like, cushion your fall in a volatile equity market, they actually accelerated the collapse. You've been told for decades that when stocks zig, bonds zag.
But in 2022, they both plummeted off the exact same cliff.
Right. So you have to ask, was that a freak storm? Like a statistical anomaly we can just write off?
Yeah.
Or is the underlying math of modern wealth management just fundamentally broken?
It is entirely broken, especially if you are still operating under the assumptions of the last 20 years.
The terrain has shifted permanently, hasn't it?
Completely. The passive tailwinds that made everyone look like a financial genius, relentless globalization, structurally low inflation, central banks just like permanently pinning interest rates to the floor, those are gone.
Yeah.
We're moving into an era characterized by capital scarcity, fractured supply chains, and frankly, violent macroeconomic regime shifts. If you are relying on the old map to secure your future liabilities, you're basically walking blindfolded into a minefield.
Okay, let's unpack this, because the mission for this deep dive is really to explore the absolute, undeniable necessity of active management in today's macro environment. We're looking at how to transition from simply, riding passive market betas to adopting a highly durable, research-driven business model.
Which is absolutely critical for the listener right now.
Right. And specifically, we're going to look through the lens of the Phalane Portfolios approach and the broader macro syndicate framework. These frameworks, which are drawn from the Capital Flows research, argue that wealth management has to be treated like a continuous laboratory.
Yes, exactly. You have to operate with Innovate, Systematize, run loop.
Which is a huge shift, right?
It's a profound shift in mindset. You're no longer just buying an index and going to sleep. You have to, actively innovate to find durable edges, systematize those discoveries into testable, mathematically sound frameworks, and then run them with just ruthless efficiency.
And to do that, you have to actually understand the causal mechanics driving asset prices, growth, inflation, and most importantly, global liquidity.
Precisely.
We have a massive amount of ground to cover today. We're pulling from a century of empirical market data on the 60/40 portfolio from Quant Decoded. We're deconstructing the mechanics of global liquidity chains using Michael Howell's Capital Wars.
Oh, that's a fascinating one.
It really is. Plus, we're redefining the mathematics of risk and drawdowns with an active asset allocation study. Then breaking down a radically different portfolio construction method called hierarchical risk parity.
Also known as HRP.
Right, HRP. And finally, looking at a CFA Institute guide on how agentic AI allows an individual investor to actually execute this complex run phase. So let's start at the scene of the crime. Let's look at the 60/40 portfolio.
Let's do it.
According to the foundational capital flows framework, the ultimate goal of any wealth management strategy is singular: meeting future liabilities.
Yeah, that's the whole point. That could be funding a pension in 30 years, maintaining purchasing power for a generational trust, or, just making sure you don't outlive your savings.
And for 2 decades, the 60/40 portfolio met those liabilities effortlessly. I mean, it outperformed highly complex, expensive active management strategies with zero effort.
Because it had a uniquely perfect macroeconomic environment. You had massive demographic tailwinds, cheap energy, and a geopolitical consensus that prioritized frictionless global trade.
Which kept inflation structurally pinned down.
Exactly. But the quant decoded data we're looking at paints a pretty terrifying picture of what happens when that specific environment ends. They ran an empirical study on 97 years of U.S. market data.
Stretching from 1928 all the way to 2025.
Right. And their findings completely shatter the illusion of the set-it-and-forget-it portfolio. First off, they found that 60/40 is highly regime-dependent.
Okay, so it's not dead overall. Right. Over the full 97-year sample, it delivered an 8.8% nominal compound annual growth rate.
True. But the devil is entirely in the distribution of those returns. The distribution is heavily skewed by inflation regimes.
Break that down for me.
Sure. So the study defines a low inflation regime as any year where the Consumer Price Index, or CPI, is at or below 5%. In those specific environments, which account for roughly 71 of the 97 years studied, the 60/40 portfolio is a juggernaut.
It delivers a 7.5% real inflation-adjusted return annually.
Right. It beats out highly engineered alternatives like risk parity or the all-weather portfolio.
So for about 3/4 of a century, the strategy looks infallible.
Mm.
But then you hit the kryptonite. The data segments out periods of stagflation.
Yeah, and this is defined precisely as years where CPI spikes above 5% and simultaneously real GDP growth drops below 1%.
The worst of both worlds. Runaway prices and a stalling economic engine.
Exactly. Out of the 97-year sample, this highly toxic configuration materialized about 8 times. The 1970s oil shocks, the early 1980s.
And the brutal reality check of 2022.
Yes. During those stagflationary regimes, the 60/40 portfolio doesn't just underperform, it actively destroys capital. It averages a negative 4.5% real return annually.
Wait, you're losing nearly 5% of your actual purchasing power every single year you remain trapped in that regime.
Every single year.
But the entire premise of modern portfolio theory assumes that when equities draw down, fixed income catches the falling knife. This is saying the underlying math actively weaponizes the bond allocation against the investor during stagflation?
That is exactly what the data reveals. It's called the correlation flip.
The correlation flip. Okay, explain that.
So, in a normal low inflation environment, the correlation between equities and government bonds averages negative 0.31. When a shock hits the system, say, a banking scare or a geopolitical event, investors panic sell equities and flood into the perceived safety of government bonds.
Right, the flight to safety.
Exactly. That wave of buying drives bond prices up, offsetting the losses in the equity portion of the portfolio. The math works perfectly.
But in stagflation, that correlation violently reverses.
Yes, it goes from negative 0.31 to positive 0.51. They start moving in lockstep, and they're both moving aggressively downward.
Walk me through the actual fundamental mechanics of why that happens. Why does the diversification benefit just vanish into thin air?
Because the nature of the shock is entirely different. In stagflation, you have 2 macroeconomic forces operating on the portfolio simultaneously, attacking both asset classes from different angles.
Right.
First, you have surging, sticky inflation. To fight that inflation, central banks are forced to aggressively hike interest rates, or the bond market simply demands a higher premium to hold debt.
And when yields spike, the mechanical reality of a bond dictates that its price must fall.
Precisely. So your 40% allocation, your presumed safe haven, is just hemorrhaging value.
And while the bonds are being crushed by rising yields, the equities are being crushed by the stagflation.
Right. That same inflation represents rising input costs for corporations. Energy, raw materials, labor, it all becomes vastly more expensive.
But because the broader economy is stalling, real GDP growth is below 1%. Consumer demand is incredibly weak.
Yes. Corporations cannot simply pass those surging input costs on to the consumer without destroying demand entirely. Consequently, their profit margins compress. Earnings collapse.
And when earnings collapse in a high interest rate environment where the discount rate on future cash flows is rising, stock valuations get decimated.
So your 60% is bleeding out from margin compression and your 40% is bleeding out from duration risk. The structural integrity of the portfolio relies on a negative correlation that only exists in a low inflation vacuum.
So what does this all mean? It sounds like 60/40 is a raincoat that works perfectly in a thunderstorm, but melts perfectly in acid rain. And stagflation is the acid rain.
That's a perfect analogy. And there is another hidden variable the quant-decoded data exposes, which is the starting yield of the 10-year Treasury.
Right. This is a vital metric that most passive investors completely ignore.
They really do. The study found a massive predictive relationship between the yield you start with and the returns you ultimately get.
If you allocate capital to a 60/40 portfolio, when the 10-year Treasury starting yield is below 3%, the subsequent decade's average real return for that entire portfolio plunges to a mere 2.1%.
Because the starting yield dictates the actual mathematical coupon income you receive. If you are buying bonds at a 1.5% yield, your 40% allocation isn't generating enough raw cash flow to offset even a minor equity correction.
Furthermore, bonds at those ultra-low yields have massive duration risk, meaning they're hypersensitive to any future rate increases.
Right. The data shows that the starting yield on the 10-year Treasury explains an astonishing 73% of the variance in the subsequent decade's 60/40 real returns.
Which means if you entered 2022 holding a passive 60/40 portfolio with yields near the zero bound, you were mathematically guaranteed to suffer catastrophic losses the moment inflation appeared. The structural margin of safety was zero.
Exactly. Zero.
So if the traditional passive model is this fragile, what's the alternative when the regime shifts? The sources look at what actually survived during those exact same stagflationary periods where 60/40 was losing 4.5% real.
And they point to the all-weather style portfolio, which fundamentally changes the asset mix.
Right. Instead of just equities and nominal bonds, it introduces a 15% allocation to broadly diversified commodities and a 15% allocation to gold.
And the results are stark. During stagflation, that all-weather configuration cut the real losses down to just negative 0.5%. It essentially neutralized the regime.
Because real assets are physically tied to the mechanics of the inflation. If stagflation is driven by an oil shock, the commodity allocation is capturing the direct upside of that soaring input cost.
Right. And if real interest rates are plunging into negative territory because inflation is rising faster than nominal yields, gold, which has zero yield but zero counterparty risk, acts as the ultimate monetary release valve.
You are functionally embedding shock absorbers into the portfolio that react to the specific macroeconomic vector causing the crash.
The research also highlights the efficacy of applying a systematic trend overlay. This is a purely active, rules-based mechanism.
Yeah, the study tested a model where an investor simply monitors the S&P 500 against its 200-day moving average, right?
Yes. If the index breaks below that long-term trend line, the rule dictates a mechanical shift of the equity allocation into cash or ultra-short-term treasury bills.
And historically, integrating that singular active rule improved the overall Sharpe ratio, the measure of risk-adjusted return, to 0.61 across all market regimes.
It forcefully amputates the left tail of the return distribution. You avoid riding the elevator all the way down to the basement during a protracted bear market.
This brings us directly back to the macro syndicate framework. You cannot passively hold a static allocation and hope the macroeconomic weather cooperates with your retirement timeline.
You absolutely cannot. You must actively monitor the causal mechanics. Specifically, you have to constantly evaluate the trajectory of the consumer price index and the momentum of real GDP growth.
Because those two vectors determine whether you are operating in the 71 years of low inflation safety or wandering into the 8 years of stagflationary destruction.
Exactly.
But if we are really embracing the Phalane Portfolios approach, GDP and CPI are only 2/3 of the puzzle. They represent growth and inflation. There is a third causal mechanic driving asset prices, and according to Michael Howell's deep dive in Capital Wars, it is arguably the most dominant and misunderstood force in modern finance.
We are talking about global liquidity.
Right. If passive 60/40 is vulnerable to regime changes, we need to understand the gears shifting behind the scenes.
And Howell's thesis fundamentally rewrites how we should analyze financial markets. I mean, traditional finance theory, the curriculum taught in every business school for the last 50 years, assumes that markets are efficient mechanisms for allocating capital based on fundamental valuation.
Right. The theory dictates that investors rigorously assess a company's future cash flows, discount them back to the present, and allocate capital to the most productive enterprises.
But Howell argues that this entire conceptual framework is hopelessly outdated.
He argues that modern markets are no longer capital allocators. They are overwhelmingly debt refinancing mechanisms.
Exactly. They aren't raising fresh capital to build new factories. They are existing to roll over an unimaginable mountain of legacy debt.
And to understand this paradigm, Howell introduces a remarkably elegant equation. He states that asset prices, which we can denote as P, are driven by global liquidity, denoted as L, multiplied by risk positioning, which is the ratio of P over L.
So the equation is P equals L times P over L.
Here's where it gets really interesting. If P equals L times P over L, then fundamentals like earnings reports are taking up a back seat to central bank plumbing. Are we all just trading the plumbing now?
To a startling degree, yes. If we connect this to the bigger picture, Howell defines liquidity not simply as the money supply, but as the total balance sheet capacity of the global financial sector.
It is the raw flow of cash, savings, and credits circulating through the architecture of the markets.
And this architecture is incredibly fragile because it is entirely dependent on collateral.
This is a crucial concept. The Capital Wars source notes that roughly 80% of all global lending now requires collateral backing. We aren't in a world of unsecured handshake loans based on credit scores anymore.
No, the system operates on secured lending chains. Let's use an analogy to make this concrete. Imagine the global banking system is a massive, complex engine.
Okay.
Corporate earnings, economic growth, technological innovation, those are the gas pedal. You can push that pedal to the floor, but collateral is the oil lubricating the engine.
And if the oil suddenly drains out, the engine seizes violently and immediately, regardless of how hard you are pressing the gas.
Precisely. And that completely reframes how we look at financial crises. The traditional narrative is that a crisis occurs because assets become irrationally overvalued, a bubble forms, and eventually gravity takes over and the bubble pops.
Howell argues that is a symptom, not the disease. Modern crises don't stem from fundamental asset mispricing. They stem from collateral shortages that violently snap the lending chains.
Look at the mechanics of 2008. The popular consensus is that housing prices simply got too high. But the actual systemic failure, the reason the global banking system came within hours of total collapse, was a collateral crisis.
Right. Mortgage-backed securities, or MBS, were being utilized as pristine collateral in the repurchase or repo markets.
Banks were using these MBS to secure the overnight loans they desperately needed to fund their daily operations. When the underlying subprime mortgages started defaulting, the perceived value of that MBS collateral just evaporated.
The lenders suddenly looked at the MBS and said, "We don't trust this collateral anymore. We won't lend against it." And instantly, the oil drained from the engine.
The banks couldn't roll over their short-term debt. The lending chains broke. It wasn't just a correction in housing. It was a heart attack in the plumbing of the financial system.
We saw the exact same mechanism play out in the 2019 repo market seizure, didn't we?
Yes, out of nowhere, overnight lending rates spiked astronomically because there was a sudden, acute shortage of cash reserves relative to the massive amount of Treasury collateral flooding the system. The engine seized.
Or look at the 2022 UK gilt crisis.
Oh, that is a perfect example of the macro syndicate framework in action.
British pension funds were utilizing liability-driven investing, or LDI, strategies. They were heavily leveraged, using UK government bonds gilts as collateral to maintain derivative positions that hedged their long-term liabilities.
And when the UK government announced a poorly received mini-budget, gilt yields violently spiked. As we established earlier, when yields spike, bond prices plummet.
The value of the pension fund's collateral plummeted overnight. The banks on the other side of those derivative trades immediately issued massive margin calls. Your collateral is no longer sufficient. Post more cash immediately.
And to raise that cash, the pension funds were forced to sell the only liquid assets they had, which were more gilts.
It created an apocalyptic doom loop. Selling gilts drove the price down further, which triggered even larger margin calls, which forced even more selling.
The Bank of England had to step in within 48 hours and unconditionally buy gilts to stop the collateral chain from completely disintegrating.
This redefines the fundamental role of central banks. They are no longer simply ivory tower economists tweaking interest rates by a quarter point to gently manage inflation.
They are the chief plumbers. Their primary existential mandate is to act as the dealer of last resort. They utilize tools like quantitative easing and standing repo facilities to permanently backstop these collateral chains, injecting synthetic oil into the engine whenever it threatens to seize.
But this constant injection of liquidity has a massive secondary effect, which brings us to Howell's critical distinction regarding inflation. He argues we have to separate high street inflation from monetary inflation.
Right. High street inflation is the CPI metric. It's what you feel at the grocery store, driven by supply chain bottlenecks, tariffs, or oil embargoes.
Monetary inflation, however, is entirely different. Monetary inflation is the deliberate, structural depreciation of fiat currency resulting from the sheer excess supply of liquidity injected into the system to maintain those collateral chains.
And crucially, that excess liquidity doesn't necessarily flow into the real economy to bid up the price of milk. It flows directly into financial assets.
It inflates the denominator. When the central bank prints $1 trillion to backstop the repo market, that liquidity inevitably searches for a home, and it bids up the prices of equities, real estate, and fixed income.
The asset prices are rising not because the underlying companies are inherently more valuable, but because the currency pricing them is being structurally debased.
This leads to the concept of fiscal dominance, which is perhaps the most sobering reality of the current macro regime. You hear constant political debates about austerity, cutting deficits, and balancing the budget. Howell's framework suggests that mathematically, austerity is no longer a viable option.
Because the sheer scale of sovereign debt is insurmountable. When you combine massive, mandatory, demographically driven welfare spending like Social Security and Medicare with a towering mountain of legacy sovereign debt, the interest expense alone consumes a massive percentage of tax revenues.
The sovereign entity must keep interest costs manageable, and it must fund its mandatory obligations. If they attempt a severe austerity, they trigger a deflationary depression.
Therefore, the debt inevitably mathematically has to be monetized. The central bank is eventually forced to step in and purchase the government's debt to absorb the issuance and suppress the yields. This guarantees a continuous, long-term cycle of monetary inflation and liquidity expansion.
And on the flip side of that equation, you have the institutional buyers operating under duration targeting. This absolutely blew my mind when reviewing the sources. The dominant players in the market, the massive pension funds and insurance companies, are not acting like Warren Buffett.
No, they are not scanning the horizon looking for fundamentally undervalued businesses. They are forced buyers.
Right. A pension fund has a highly specific, legally binding schedule of future liabilities. They know they have to pay out $1 billion in exactly 20 years.
Therefore, their regulatory mandates force them to purchase assets that match that specific duration. They have to buy a 20-year bond, regardless of whether the yield is fundamentally attractive or if the asset is historically wildly overvalued.
They're completely price agnostic. They're buying to match a liability duration, not to allocate capital efficiently. This fundamentally distorts the demand curve for collateral and further decouples asset prices from economic reality.
Exactly. So if we synthesize all of this, the mandate for you, the active manager of your own wealth, is radically altered. You cannot just read an annual report and assume you have an edge.
You have to monitor the 65-month global liquidity cycle. You have to watch the plumbing. In a liquidity crunch, when those collateral chains start snapping, correlations go to 1. Every asset gets liquidated to raise cash.
In that specific regime, fundamental valuation is irrelevant. The only things that survive are pristine, safe assets, like the US dollar or physical gold.
Which naturally forces us to confront a highly uncomfortable truth about how the financial industry measures risk. If the market is essentially a fragile, collateral-driven liquidity machine, the biggest risk to the listener isn't standard volatility. It's a catastrophic drop in liquidity that wipes out their portfolio.
Yeah.
We need to redefine how we measure risk.
Yes. The standard metric used to gauge the safety of a portfolio is dangerously inadequate. I am talking about volatility.
The standard deviation, the metric slapped on every mutual fund fact sheet in the world. The industry is completely obsessed with volatility, but according to the deep dive from active asset allocation, volatility is a fundamentally flawed, almost deceptive metric for anyone actually trying to meet future liabilities.
The fatal flaw of standard deviation is that it completely ignores the sequence of returns. It only measures the dispersion of returns around an average, treating time as irrelevant.
To illustrate how absurd this is, let's look at a hypothetical portfolio. Imagine a strategy that loses exactly 1% of its total value consistently every single day without fail.
Mathematically, the standard deviation of that portfolio is absolutely zero. There's zero variance. It is a perfectly smooth, predictable line.
By the industry's primary definition of risk, that is the safest portfolio in existence. Yet in reality, you are steadily, irreversibly going bankrupt.
To bring empirical data to that concept, the research cites Peter G. Martin's fascinating S&P 500 experiment. He took the actual historical monthly returns of the S&P 500 over a specific time frame and simply rearranged the sequence of those exact same returns.
Right, he created two alternate realities. In the first scenario, he arranged the monthly returns in an ascending order. He took all the worst, most catastrophic monthly losses and stacked them back to back at the very beginning of the timeline, followed by all the massive gains at the end.
And in the second scenario, he distributed them in a sawtooth pattern, a brutal loss, immediately followed by a strong gain, then another loss, then a gain, oscillating back and forth.
Now, because the underlying data points are exactly the same, the traditional mathematical volatility, the standard deviation over the total period, is identical for both portfolios. A quantitative analyst looking only at volatility would tell you these two portfolios carry the exact same amount of risk.
But the actual human experience, the real-world outcome of those two sequences, is staggeringly different. The maximum drawdown, which is the measurement from the highest peak of the portfolio to its lowest valley for the sawtooth pattern, was essentially a standard bear market. Painful, but survivable.
But for the ascending order, where all those severe losses compounded consecutively before any gains could materialize, the maximum drawdown reached a catastrophic negative 99.9%.
You would have been entirely wiped out. The sequence destroyed the capital base before the gains could ever be realized.
Think of volatility as the turbulence on a flight. It feels scary, but you're usually fine. Drawdown is the plane actually losing altitude. If you lose enough altitude, you crash. We shouldn't be optimizing for a smooth ride. We should be optimizing to stay in the air.
That is exactly right. This highlights why maximum drawdown, or MD, is the only metric that truly captures existential risk. And the reason drawdowns are so incredibly lethal is because of the base effect.
This is the cruel, unforgiving mathematics of percentages. Losses and gains are highly asymmetric. If your portfolio suffers a 20% drawdown, a 20% gain does not make you whole. You are starting from a smaller capital base. You need a 25% gain just to get back to the starting line.
And that asymmetry becomes exponentially more punitive the deeper the drawdown goes. The active asset allocation study highlights the devastation of the NASDAQ 100 during the dot-com collapse in 2002. The index suffered a peak-to-valley drawdown of roughly 83%.
To recover from an 83% loss, you don't need an 83% gain. You need a 483% gain. You have to essentially 5x your money just to break even.
And the empirical data shows that it took the NASDAQ 142 months, nearly 12 grueling years, just to claw its way back to its previous peak.
12 years completely underwater. This is the mechanism that destroys generational wealth, and it is heavily compounded by the realities of human psychology and institutional mechanics.
Right. We have to look at behavioral finance here. Kahneman and Tversky's prospect theory proved that human risk aversion is deeply asymmetric. Neurologically, the pain of losing capital registers far more intensely than the satisfaction of gaining an equivalent amount.
When an investor, even a sophisticated institutional portfolio manager, is staring at a 40% drawdown, the psychological pressure becomes agonizing. An active drawdown limit prevents the investor from panic selling at the bottom.
And it's not just psychology, it's institutional structure. A portfolio manager facing a severe drawdown will often trigger hard-coded risk limits. The compliance department steps in and says, your value at risk has exploded, you must deleverage immediately.
So they are forced to sell their assets at the exact moment of maximum distress, at the absolute bottom of the market, locking in a temporary impairment as a permanent realized loss.
This is why the sources introduce a far superior risk metric called the Ulcer Index.
The Ulcer Index. I love that name. It's so visceral.
It is. It doesn't just calculate the depth of the deepest valley. It computes the quadratic mean of percentage drawdowns over the entire period. It mathematically quantifies both the severity of the drop and the duration of the time spent underwater.
So a portfolio that drops 20% and recovers in a month has a low Ulcer Index. A portfolio that drops 20% and stays there for a decade has a massive Ulcer Index.
Exactly. So how do you actually defend against this? The active asset allocation paper advocates for a framework they call DARM, Dynamic Asset and Risk Management. It is a systematic rejection of passive hope.
The foundation of DARM is establishing a rigid, inviolable mathematical floor. An investor decides, based on their liability schedule, I mathematically cannot tolerate a drawdown exceeding 15% without jeopardizing my retirement.
Once that floor is established, the DARM system dynamically rebalances capital between a safe asset bucket like short-term treasuries and a performance-seeking bucket like equities or commodities. The allocation is dictated purely by the distance between the current portfolio value and that 15% floor.
When the market is rallying and you have built up a massive cushion above your floor, the system systematically allocates heavier into the performance bucket, capturing the upside momentum.
But the moment the market turns, as that cushion compresses and you approach your 15% limit, the system mechanically, unemotionally strips capital out of equities and locks it into the safe assets. It actively truncates the left tail of the distribution. It guarantees you stay in the game.
True diversification isn't just holding different assets. It's active downside risk management to preserve the floor, so management fees and future liabilities are protected.
But this brings us to the most complex hurdle in the entire macro framework. We know we have to abandon static 60-40 and stagflation. We know we must pivot from corporate earnings to monitoring global liquidity. We know we must strictly optimize the portfolio to prevent maximum drawdowns rather than chasing low volatility.
So mathematically, how do we actually construct this portfolio? Because the traditional algorithm that the entire financial industry uses to build optimized portfolios is fundamentally defective in a liquidity-driven macro regime.
It really is. For over half a century, the unquestioned gold standard has been Harry Markowitz's mean variance optimization, or MVO. Markowitz literally won a Nobel Prize for this. It is the absolute bedrock of modern portfolio theory.
The theoretical elegance of MVO is undeniable, but practitioners executing it in the real world constantly run into a catastrophic mathematical failure known as Markowitz's curse.
To understand the curse, we have to look under the hood at how the algorithm actually functions. To find the optimal mathematical weight for every asset in a portfolio, The MVO utilizes the critical line algorithm.
And this requires the system to invert a covariance matrix. Covariance matrix is essentially a massive, multidimensional grid that maps exactly how every single asset in your universe moves in relation to every other asset.
And here is where the math collides violently with reality. The linear algebra required to successfully invert that matrix fundamentally assumes that the assets are reasonably independent of one another.
But we just established in our discussion of global liquidity that modern markets are dominated by collateral chains. During a systemic shock, assets are emphatically not independent. Correlations converge toward one. Everything moves together.
When assets become highly correlated, the covariance matrix becomes what mathematicians call ill-conditioned. The sources highlight an example of a matrix with a condition number of 150.93.
Now, in linear algebra, a condition number over 30 generally indicates that the matrix is catastrophically unstable. It is teetering on the edge of being a singular matrix, which is mathematically impossible to invert accurately.
Trying to invert an ill-conditioned matrix is like trying to balance a bowling ball on the tip of a needle during an earthquake.
The practical result of this mathematical instability is terrifying. Because the matrix is so sensitive, a microscopic estimation error in your expected returns being off by a fraction of a percent in predicting a stock's yield causes the entire optimization algorithm to blow up.
It will spit out a wildly erratic, hyper-concentrated portfolio, potentially allocating 90% of your capital into just two highly correlated assets, completely destroying any illusion of diversification.
Furthermore, to estimate a 50-asset covariance matrix with enough statistical accuracy to avoid those errors, you would theoretically need 5 years of daily, perfectly independent stationary data. But the correlation structure of financial markets is constantly mutating. The relationship between gold and the yen today is not what it was 3 years ago. The data is never stationary.
Which means the Nobel Prize-winning math fundamentally fails exactly when you need it most during a systemic liquidity crisis.
But the sources introduce a revolutionary modern solution to bypass Markowitz's curse entirely. It is a mathematical model developed by Dr. Marcos Lopez de Prado called hierarchical risk parity, or HRP.
HRP is a paradigm shift. It completely abandons the fragile quadratic optimizers and matrix inversions of the 1950s. Instead, it leverages modern machine learning and graph theory to extract the deep structural information embedded within the correlation matrix without ever needing to mathematically invert it.
The Wikipedia breakdown details the 3 distinct sequential steps of the HRP algorithm. Let's walk through how this actually builds a bulletproof portfolio.
The first step is hierarchical clustering. The machine learning algorithm analyzes the entire universe of assets and begins grouping them into a tree-like hierarchy based purely on their correlation distances.
So it observes the data and identifies asset A and asset B behave almost identically in various regimes. They form a tight microcluster. Asset C and asset D behave similarly to each other, forming another cluster.
Right. It organically builds this tree structure from the bottom up without any human assumptions about what asset belongs in what sector.
I think of this like organizing a highly volatile, potentially explosive dinner party.
Oh, that's a great way to put it.
Right. Markowitz's mean variance optimization attempts to force all 50 guests into one giant, unstable conversation. If one person sparks a massive argument, the entire dynamic of the room collapses. That's the ill-conditioned matrix blowing up.
Yes.
Hierarchical clustering acts as a brilliant host. It groups the guests by their specific temperaments and interests into smaller, highly stable tables. The tech stocks are at one table, the commodities at another. That way, if an idiosyncratic shock hits, if the tech table descends into an argument, it is mathematically contained. It doesn't trigger a systemic contagion that ruins the conversation at the commodity table. The structural integrity of the party survives.
That is a highly accurate visualization of the mechanism. Once the algorithm has established those stable clusters, it moves to step 2, quasi-diagonalization.
Okay, what's that?
This is essentially a data reorganization process. It rearranges the rows and columns of the covariance matrix so that the investments that are most highly correlated are physically placed adjacent to each other in the mathematical structure.
So it is grouping the similar tables together in the dining room to streamline the final allocation.
Exactly. And that final allocation is step 3, recursive bisection.
Okay.
This is where the actual capital gets distributed, and it operates completely differently than traditional models.
How so?
Recursive bisection operates top-down across the clustered tree. It looks at the two massive primary branches of the portfolio and splits the capital between them based on inverse variance, meaning it allocates more capital to the branch that exhibits lower overall risk. Then, it recursively moves down to the next sub-level of the branches, splitting the capital again based on the variance of those specific subclusters. It repeats this process iteratively down the entire tree until every single individual asset has a specific mathematical weight.
The profound genius of this approach is that an asset is only ever competing for capital against similar assets within its own specific cluster.
Yeah.
A high-volatility tech stock is competing for a slice of the pie against other high-volatility tech stocks.
It is never directly competing for capital against a safe haven asset like gold. This prevents the algorithm from creating those wildly concentrated barbell portfolios that MVO is notorious for.
And the empirical robustness of HRP is undeniable. The source details a massive out-of-sample Monte Carlo simulation comparing the traditional critical line algorithm used in MVO against the HRP model.
Yes, they bombarded both portfolios with thousands of randomized synthetic market shocks. The traditional CLA method exhibited a highly unstable out-of-sample variance of 0.1157. The HRP portfolio was vastly superior, demonstrating a variance of only 0.0671. It cut the instability almost in half.
The documentation also explicitly highlights why HRP is superior to standard risk parity, often referred to as inverse variance portfolio, or IVP.
Yeah.
Standard risk parity simply allocates capital to assets based on their individual volatility, but it completely ignores the correlation between them.
It treats every guest at the dinner party as if they're sitting in a soundproof booth, entirely isolated. Consequently, standard risk parity is highly vulnerable to systemic, liquidity-driven shocks where correlations converge.
Right. HRP succeeds because it balances the idiosyncratic risk of the individual asset against the systemic risk of the specific cluster it belongs to. You don't need accurate expected returns to build a robust portfolio. Using machine learning on the covariance matrix alone provides superior, durable diversification.
It creates a portfolio that is organically diversified, deeply resilient to regime shifts, and entirely immune to the mathematical fragility of Markowitz's curse.
So let's synthesize the map we've constructed for this new terrain. We've established that passive 60/40 is a death trap in stagflation. We've determined that asset prices are driven by the mechanics of global liquidity and collateral chains, not just corporate fundamentals.
Yes.
We've redefined risk management, shifting focus from meaningless volatility metrics to actively managing maximum drawdowns via a hard floor. And we now have the mathematical architecture hierarchical risk parity to construct the optimal portfolio.
We have successfully mapped the Innovate and Systematize phases of the macro syndicate framework, but we are faced with a massive execution bottleneck, the run phase.
Exactly. The sheer computational and operational bandwidth required to execute this framework is staggering. If you are an individual investor managing your own family office, or even a lean boutique advisory firm, how do you continuously monitor a 65-month global liquidity cycle?
You don't, at least not manually.
Right. How do you scrape global central bank data to detect shifts in repo market collateral? How do you run daily covariance matrix clustering algorithms to dynamically adjust your drawdown floor? Doing this manually would require a team of 20 quantitative analysts working around the clock.
Historically, yes. This level of institutional-grade dynamic active management was the exclusive domain of multi-billion-dollar quantitative hedge funds.
But the final source we are unpacking, a cutting-edge guide from the CFA Institute, reveals that the barrier to entry has violently collapsed to near zero. The tool that empowers the run phase of this entire operation is agentic AI.
This is where we have to separate reality from the mainstream hype. We are not talking about opening a chatbot window, typing, "build me a good portfolio," and blindly following the output.
Definitely not. The CFA Institute defines agentic AI as a fundamentally different architecture. An AI agent operates autonomously. It doesn't just generate text, it takes independent actions.
It utilizes external tools. It writes Python code to pull live data from Bloomberg APIs. It deploys web scrapers to read central bank minutes. It performs complex mathematical calculations.
It also possesses memory architecture, utilizing RGRAG retrieval augmented generation vector databases to recall past macroeconomic research and prior allocation decisions. And most crucially for financial applications, it operates within strict deterministic guardrails.
The CFA guide makes a vital structural distinction between rigid workflows and fully autonomous agents. If you are managing actual hard-earned capital, you do not want a completely autonomous agent operating with zero oversight, hallucinating a trade because it misinterpreted a headline. You want highly regulated, AI-driven workflows.
Let's break down the specific patterns the CFA highlights, because this is how you practically build the run loop.
The first pattern is prompt chaining. This is a highly deterministic linear sequence. You program the AI to execute step 1, hit an API to download the daily CPI and GDP data. The output of step 1 automatically triggers step 2. Run a statistical check to see if those numbers breach the stagflation thresholds we discussed earlier.
The output of step 2 feeds step 3. Format a summary alert for the portfolio manager. It is a rigid assembly line.
Then you have routing workflows. The AI acts as an intelligent traffic cop. It analyzes an incoming stream of data and dynamically decides which specialized analytical model should process it.
If the router detects news about a sovereign debt auction, it routes that data to a specific liquidity tracking tool. If it detects an earnings report for a semiconductor company, it routes it to a discounted cash flow tool.
The third pattern is parallelization, which solves the bandwidth issue entirely. If you need to calculate the net debt to EBITDA ratios for all 500 companies in the S&P 500 to check for bankruptcy risk, a human analyst would take weeks.
The AI fans the task out, spinning up 500 parallel processes simultaneously, crunching the fundamental data in seconds, and synthesizing the final ranked list.
Which leads into the orchestrator workers model. You have a central boss AI that receives a complex macro objective, for instance. Calculate the current ulcer index of our portfolio.
The boss breaks that complex task into discrete subtasks and delegates them to highly specialized worker models. One worker model pulls the historical pricing data. Another worker model writes the specific quadratic mean formula. A third worker executes the math. The boss then orchestrates all the returning data into a final report.
But the most powerful workflow for portfolio construction is the evaluator optimizer loop. This introduces an internal system of checks and balances.
Right. You have a primary AI model that drafts an initial portfolio allocation based on the HRP clusters. But before that allocation is finalized, a secondary evaluator model actively critiques it against your predefined risk limits.
The evaluator might say, this allocation breaches our 15% maximum drawdown floor based on historical stress tests. The primary model receives that critique, revises the weights, and resubmits it. They loop iteratively until the portfolio perfectly aligns with the parameters.
Now contrast those highly structured, rigid workflows with a true autonomous agent. The guide details the REACT framework, which stands for Reason plus Act. This is where the AI starts to mimic human cognition.
In a REACT framework, the LLM is given a high-level goal, and it has to figure out how to achieve it independently. It generates an internal chain of thought. My goal is to find the true free cash flow of this company. First, I need to locate their most recent 10K filing.
It then takes an action. It writes the code to hit the SEC at GR database. It then observes the result. If the code fails, it reasons again. The API endpoint changed. I need to rewrite the request using the updated format.
It loops through this reason act, observe cycle dynamically until it successfully extracts the exact cash flow number.
To see how all these pieces fit together into a unified system, let's walk through case study 3 from the CFA guide, Agentic AI-Augmented Portfolio Construction.
Imagine you operate a boutique wealth management firm using the Phalane Portfolios approach. You have a client who requires a custom dividend yield strategy. However, they also mandate that the portfolio must pass a rigorous sustainability screen, and crucially, they only want companies mathematically positioned to survive a transition into a stagflationary macro regime.
Executing that manually across a universe of thousands of equities is impossible, but the AI agent orchestrates the entire operation seamlessly. First, using parallelization, it extracts the fundamental data for every stock in the Russell 1000 and constructs the baseline dividend factors evaluating current yield, historical payout ratios, and dividend growth consistency.
Then it deploys the AI sustainability screen. But it doesn't just download a static, often deeply flawed ESG score from a legacy vendor. It uses an evaluator optimizer workflow to execute deep web research.
It deploys scraper agents to read the actual engineering patents the company filed last month, scores their real-world adoption of green supply chain tech, and evaluates the language used by executives in recent interviews to assess future transition strategies.
Next, it executes the macro regime screen. It fetches the corporate income statements and utilizes a Routo workflow to push the data through the specific stagflationary criteria set.
It calculates advanced leverage metrics, evaluates pricing power by analyzing gross margin trends over the last 3 inflationary spikes, and rigorously scores the company's fundamental resilience to slowing demand and surging input costs.
Finally, the orchestrator AI synthesizes all of these discrete data streams, the fundamental dividend factors, the dynamic sustainability score, and the stagflation macro resilience score into a composite multi-dimensional rank.
It selects the top 50 companies that survive this brutal gauntlet and passes that precise universe into a hierarchical risk parity algorithm to cluster them and lock in the final, optimally diversified weights. It just executed a month of institutional quantitative research in roughly 4 minutes.
But as powerful as that is, we have to address the elephant in the room regarding AI in finance. How do you prevent the system from making a catastrophic unforced error? If an LLM is predicting the next word probabilistically, it can hallucinate.
Okay, but can we trust an AI with actual capital? What if it hallucinates a macro regime or a tool call? It could invent a fake API response, hallucinate a spike in global liquidity that hasn't happened, or confidently execute a trade that breaches your drawdown floor.
That is the exact vulnerability the CFA guide addresses with the implementation of MCP, the Model Context Protocol, and strict deterministic guardrails. MCP is essentially a standardized plumbing layer that dictates exactly how the LLMs are allowed to interact with external tools and data sources.
It creates an isolated, secure environment so the AI cannot arbitrarily pull unverified data from a random blog.
And to neutralize the risk of hallucination in these critical routing and scoring tasks, you manipulate the model's parameters. Specifically, you set the LLM's temperature to absolute zero.
Temperature is the parameter that controls the randomness or creativity of the model's output. By setting it to 0, you force the AI to become completely deterministic. Given the exact same financial data and the exact same prompt, it will output the exact same mathematical score every single time.
You strip away the creativity and turn it into a relentless, high-functioning logic engine. You use non-reasoning, highly predictable models for the routing and filtering tasks. You implement massive input guardrails that automatically reject any data that falls outside of expected bounds.
And most importantly, for the final execution phase, you hard-code a human-in-the-loop constraint. The AI does all the heavy lifting, the clustering, the regime detection, but it physically cannot execute a rebalancing trade without a human portfolio manager reviewing the output and clicking approve.
In the high-stakes, zero margin for error world of wealth management, constructing rigid, deterministic workflows augmented by AI is vastly safer and more effective than unleashing purely autonomous agents.
The ultimate synthesis of this entire deep dive is empowering. The barrier to entry for institutional-grade active management has fallen to 0. With agentic AI, the listener can build a personal laboratory that monitors global liquidity, identifies stagflation regimes, applies HRP clustering, and limits drawdowns autonomously. You no longer need a skyscraper full of analysts.
Active management is no longer a theoretical ideal or an expensive luxury. In a world where passive 60-40 strategies melt down under structural inflation and where global liquidity violently dictates asset prices, a dynamic, research-driven business model is the only mathematical way to ensure you meet your future liabilities.
We started with the illusion of the passive 60-40 portfolio, learned to read the underlying mechanics of global liquidity and stagflation, realized we must protect against maximum drawdowns rather than volatility, and discovered how HRP and agentic AI empower the ultimate innovate, systematize, run loop. But stepping back, looking at this entire ecosystem we've described well, it forces a massive, almost philosophical question about the future of the market itself.
This raises an important question. As these highly efficient, AI-driven, liquidity tracking, HRP-optimized systems become the standard across the entire financial industry, what happens to the market itself? If every AI agent identifies a liquidity crunch and simultaneously attempts to recluster assets and sell to protect their drawdowns, does the AI ecosystem actually create a new type of hyper-correlated crash?
A machine stagflation.
Exactly. A cascading failure of liquidity driven entirely by defensive algorithms, which no current mathematical model can possibly predict. If the map is reading the map with perfect efficiency, does the act of observing the terrain violently alter it?
That is a wild, incredibly sobering thought to leave you with. Thank you for joining us on this exhaustive deep dive. We encourage you to rigorously question your own passive frameworks, stress test your portfolio against the mechanics of stagflation, and continue innovating how you actively protect your future liabilities.